On July 24th and 25th, the US stock market had a couple of very nasty trading sessions. In fact, in the last 7 trading sessions, the S&P 500 is down by almost 5%, and the Magnificent 7 on average are down 12.5%. Is this the start of a major crash in the stock market, or is this just another relatively minor pullback? In this video, I'm going to be going over some of the factors that you're going to need to evaluate before you make decisions about what actions to take in your trading and in your investment portfolios. Specifically, I'm going to be evaluating the likelihood that the US stock market could experience a flash crash or some other major type of decline in the next few days or weeks. The first thing that I want to do in this video is go over the market action in the last few days and review where we stand right now in the market. Let's start out by examining a candlestick chart with data for about 4 months so that we can put the recent declines into some sort of perspective. So what we see here is that we peaked on July 16th. We gapped down pretty hard and went down pretty hard for a couple of days. Then the market tried to recover a little bit, but then we had a really big gap down day yesterday where the market was down over 2%. Now, yesterday was a very important trading day because we fell below a very important trend line that traces all the way back to April 18th. In addition, we fell below an important support level that went back about a month. So yesterday broke through very important supports, but it stopped at around the 50-day moving average. Now today the market started down, but then it recovered really hard. But we ended up the day 0.5% down, and that's what's really interesting. And so I want to actually look at that intraday action that we had today. So this is a 15-minute chart with the action over the last couple of days. What you see here is that yesterday we gapped down really hard, and then we just continued to sell off relentlessly throughout the day. And we ended up with a big down day of over 2%. Then today, we were actually selling off pretty substantially during the overnight session. But then right before the open, the market started to rally, but we still started out a little bit below yesterday's close. But then the market just rallied extremely strongly during the first part of the day. It peaked and then it reversed down really, really hard. All right. And that reversal brought us down to basically to the lows of the day. And we ended up actually down 0.5% for the day. Now, this type of intraday reversal is extremely bearish. When you start out the day rallying by this much and you end up down for the day, that's a very bearish signal, particularly when it's followed by such a strong down day like we had yesterday. Now, getting back to the daily chart, what I want you to see right here is that we've actually fallen into a gap right here. And so right now, we may very well fill this gap, but immediately after we fill this gap, we're going to be moving into a very, very important, very strong support zone here. And so really what this video is about today is what is going to happen when this market moves into this support zone. Is this support zone going to hold, or are we going to break through it? So in order to understand what's going to be happening in the US stock market over the course of the next few days and weeks, you have to understand what is happening with a group of stocks called the Magnificent 7. Now, I have in this table here 8 stocks because sometimes Netflix is included into that group. And what we see now here is that the S&P 500 is down about 4.7%. These stocks are down by a lot more. These stocks have been leading the decline in the S&P 500. We actually have Nvidia and Tesla down by over 20%. And among these stocks, the one that has fallen the least, Apple, is down 8.32%. So even it has severely underperformed the market. The median stock in this group is down about 12.5%. So this group has been leading the way down. And this group is also going to determine what happens going forward. Now, you have to remember that this was the group that led the market all the way up during this very, very violent rally that we've been having since the beginning of this year and even the beginning of last year or the end of last year. So the fate of the market going forward is going to be in the hands of this group as well. One of the important things to understand about this group and about the whole market is that about 5 out of these 8 stocks are going to be reporting their earnings in the next week or so. Tesla and Google already reported and they were hit very hard. We still need to see the rest of the earnings. But if we get bad earnings or bad guidance from any of these stocks, this could be a catalyst for continued downside in the overall market. By the same token, if we get some good earnings reports out of these companies, that could provide the market with support and it could bring an end to the decline that we've seen to this point. In order to figure out what's going to happen in the next few weeks, this is one of the most important charts that I'm going to be showing you today. This is a chart of CTA positioning in U.S. equities. CTA stands for Commodity Trading Advisors. And almost all of this money is what we call momentum money. They buy stocks when their signals tell them that there's positive momentum, and they sell stocks when their signals tell them that momentum has been broken to the downside. Now, what we can see here is that we are very much off sides, so to speak. CTAs haven't been this overpositioned in years. So almost in any scenario, pretty much, and this chart is from the Goldman Sachs trading desk. And over the next week, since we're so overpositioned, almost in any scenario, we're going to be getting selling. But in a down tape, and this isn't a fairly modest down tape, we're going to be getting $8 billion in selling from these CTA portfolios because they're so overpositioned. Now, this is extremely important. These guys are value insensitive traders. They don't care anything about what the value of stocks are when they buy, and they also don't care about the value of stocks when they sell. All they care about are their quantitative trading signals, which are mainly momentum signals. When momentum reverses, we could get a tremendous amount of selling. Not only would they sell back to neutral, they can actually go short the market. So we've got $120 billion potentially that we could have in reversal in the positioning of this group. And that's a tremendous amount of supply to be put out on the market in this market, which is actually relatively illiquid right now. Now, in order to understand how and why this reversal in CTA positioning could cause a flash crash in the market, I really need you to see my latest video, the one right before this one, on the possibility of a flash crash. In that video, I explained exactly how it is that a flash crash can happen in the current environment. Now, in that video, I explained that short-term traders that are momentum traders are value insensitive. When there's a big decline in the market, they completely abandon the market on the buy side and they become only sellers. They start selling into a decline really hard, and they just start hitting the bids, whoever buys them at whatever price, because they just simply need to get out of the market. They're not worried about whether the stocks are cheap. They're simply following a trading signal. And so the question is, who's going to be on the other side of the market? And one of the things that I explained is that in a situation like this, it's very unlikely that passive investors are going to be on the other side of the market. The only investors that are really going to be on the other side of the market to buy are value sensitive investors. These are fundamental investors. But what's the problem? Fundamental investors that are sensitive to value aren't interested in buying these extremely expensive Mag 7 stocks at these extremely high valuations at a price that's maybe 2 or 3% below the market. There's only going to be a substantial amount of value sensitive demand with prices that are at least 20% lower. This is really key now. If we start breaking below key support levels in the market, these value insensitive CTA funds that are momentum traders are going to start selling hard, really hard into the market, and they're going to start hitting bids. And those bids, as I pointed out, can be 10, 15, 20% or more lower. And that's where we get the possibility of a flash crash. Now, I want to come back to the CTA positioning graph for just a moment, just to illustrate how important it can be if we get a reversal in the positioning of these CTAs. Now, back in late 2022, we got some selling by CTAs that caused a little bit of a decline. Then we got a recovery of positioning back to very high levels. But then in late 2022, right about when the market was sniffing out the possibility of a Russian invasion of Ukraine, we started getting CTA positioning selling off really hard. And then we went all the way down from about a $60 billion long position back to neutral, and we actually went all the way short. Got a little recovery, and then we went back down even lower. This whole movement ended up being around a 20% decline in the market. And a lot of this decline was driven by relentless selling, short-term selling by CTA funds that were offsides, that were over-positioned in the market right before the fundamental catalyst happened. We got another situation here where we had not as high, but we had some very high CTA positioning. We got some bad inflation numbers, and we got some hawkish comments by the Fed, and all of a sudden, from a very strongly CTA position of around $60 billion, we came all the way down and went short. When all was said and done, the market lost about 10% of its value in a fairly short period of time during this decline. So we're at a position here where we're actually above where we were before this most recent 10% decline that we had late last year. And we're about where we were right before we got the catalyst of the Russian invasion of Ukraine, where the market fell by 20%. What I'm really trying to point out here is that we are perfectly positioned to get a huge amount of supply onto the market. Now, a lot of this selling was actually relatively gradual. It actually happened over the course of several weeks and months, but doesn't have to be this way. If the market goes down fast enough and it breaks through important technical supports, a lot of this CTA money can just start flooding out very fast, and that can cause a flash crash, especially if it happens in conjunction with other sources of supply in the market. So let's go back to our daily chart going back by about a year in order so we can see the most important inflection points which will determine whether we actually get into some sort of a crash sequence. We really did just break through an extremely important trend line, and we just broke through some very important horizontal support. But we're getting fairly close to a very major area of horizontal support, which goes all the way back here to the April high. We have here the June high, and we have here the June low. All of this entire area, therefore, constitutes a very, very important area of support for the market. Now, I don't think that we're actually going to break through this area unless we get some sort of a fundamental catalyst. Various things could serve as a catalyst to get through this area. Potentially, for example, if we got some really bad earnings from some of the Mag 7. Once we get to the very top of this range, which could really be just in the next couple of days, I do expect the market to have some sort of a bounce out of here, again, unless we get some sort of fundamental catalyst. The most normal thing to happen would be is if we hit this area, maybe a little bit below, and we start coming back and potentially even hit the underside of this rising trend line here. Again, it's all going to depend on what kind of news we have in the next few days, especially regarding earnings. And certainly if we got any news out of the Middle East in terms of an intensification of the crisis there, that could turn out to be the fundamental catalyst that could really get us through this important support area. Now, If this support area doesn't hold, we're going to go down probably pretty hard into a real empty space here, all the way down to about 5,000 or a little bit below on the S&P. This is where we're also going to hit, roughly speaking, it's going to actually be a little higher than this. We're going to hit the 200-day moving average, which is an indicator that, as you know, a lot of people follow very closely. Now, just from a technical perspective, this line right here, which is down about 13% from the high, and also it happens to coincide roughly with the 200-day moving average. If we get below this, this would probably be a bear market signal. It means that we'd probably end up with a decline of 20% or more, with a first objective somewhere in between this area here and all the way down in here. Now, again, I don't think, because this is such an important support line, I don't think that there's any way, or not that there's not any way, but I think it's highly unlikely that we're going to get below such an important support level that would be signaling a bear market unless something happens fundamentally that really threatens the economy. Something that would have to be as serious as, let's say, an oil price shock. And for that, I need you guys to watch my couple of videos that I've had that cover the possibility of an oil price shock. As you all know, I think there's actually a very high probability, a pretty significant probability, a little over 50%, that we're going to get an oil price shock between now and the end of the year. And if that happens, that would be the sort of fundamental catalyst that we would need to get below this level. Otherwise, I think it's likely that this decline is going to end somewhere in here. Although if we get some sort of other fundamental catalyst, let's say a minor one, let's say investors start getting bearish about Kamala Harris's economic policy, and she looks like she's the front runner, people could get nervous. That could cause potentially something like this. More likely, I think, though, would be as if we got some disappointing earnings or guidance by the Mag 7. That's the type of things that could cause us to break through here. But to get through this level of support, normally speaking, I don't think that's going to happen unless we get a major fundamental catalyst. Now, let me go back and relate this to CTA positioning and the positioning of other value-insensitive traders and investors and passive investors. Everything I just mentioned here is sort of a conventional analysis. But if these declines happen fast enough and we get enough of an imbalance of supply versus demand, where we get a rush of supply from these value-insensitive investors and there's simply not enough demand, particularly in that sort of a situation, the marginal buyer is going to be a value-sensitive buyer, and value-sensitive buyers are not going to be buying stock in any great amount unless we get significantly lower, particularly in the case of the Mag 7. As I mentioned before, most value investors aren't going to be interested in buying Mag 7 stocks unless those stocks are probably at least 20% lower. The speed with which we go down is actually extremely important, because if we go down really fast, it's going to trigger a lot of supply to come onto the market, and there's simply not going to be anybody on the other side of the market that are value insensitive investors. All that value insensitive money is going to abandon the buy side of the market, and the only people on the buy side of the market are going to be value sensitive investors, and those value sensitive investors are going to have reservation prices that are probably in the range of 20% or more below where the market is right now. So that's what you guys need to understand about where we stand in the market right now. Now, there is one constituency of buyers that can get on to the buy side of the market that could halt this decline, which are the companies themselves, through share buybacks, through share repurchases. That's why we're going to probably need a fundamental catalyst that brings a tremendous amount of supply onto the market that can overwhelm even the buying power, which is a tremendous amount of buying power on the part of the Mag 7, which have huge cash reserves and have huge buyback programs that can buy a lot of shares if their shares are falling really hard. However, even that can be overwhelmed if we have enough traders liquidating, if we have enough options players liquidating, and it's certainly if we start getting some selling by passive investors. If we get that sort of powerful quantity of supply onto the market, the demand that can be provided by share repurchases won't be enough to halt the decline. And again, the only investors that'll really be the marginal buyers in the market will be value sensitive buyers, fundamental investors that are really not interested in these stocks, particularly the Mag 7 stocks, unless they get significantly cheaper. So let's sum up and conclude. First of all, the market has broken through some very important technical supports. There's some very important supports just below current levels. If we break through those supports, a tremendous amount of supply is going to be unleashed onto the market. The supply is going to be coming from value insensitive traders. And they're going to start hitting the bids, and those bids are going to be substantially lower. Now, in order for us to go really low, we're going to have to probably get some sort of a fundamental catalyst that causes the supply that's coming onto the market to not just be these CTA momentum traders, but that brings in other constituencies of sellers onto the market as well. If this occurs, it'll overwhelm even the buying on the part of the Mag 7 and their huge cash hoards to make repurchases. And then we're going to get into that position where sellers will start having to hit the bids of fundamental investors that are 20% lower than current prices in the market. That's the danger of a flash crash, and those are the inflection points that you need to be watching to see if we might be able to get that sort of flash crash. Several keys. First of all, the technical triggers. Second, the speed with which the decline occurs. Remember, the faster the decline occurs, the greater the danger. The faster we go down, the more supply actually comes onto the market, and then you get this massive imbalance of supply relative to demand. Now, you also need to pay attention to fundamental catalysts that could unleash more supply onto the market. The most likely scenario, unless we get some fundamental catalysts, unless we get some of the fast selling that I mentioned before, is that the market is going to halt its current decline at around the support levels that I mentioned when I was showing you the graph, that support area that was the sort of gray support zone. That's the most likely area where this decline is going to stop, unless we start getting some fundamental catalysts that will cause us to fall below those supports, which will in turn unleash more supply onto the market, more of an imbalance of supply relative to the demand. Then we move down to the next big support level, which is about minus 13% relative to the high, and that's our bear market trigger. I think we're going to get a lot of demand into the market right around that level that'll likely hold the market up unless we get a very important catalyst. If we get an important catalyst, we crash through it and we go down 20% or more. Two more things before we wrap up. First, hit that subscribe button. I'm going to be following this like a hawk, and if you want to know what's going to happen, and if you want to know whether or not we're going to get this crash, you're going to want to be subscribed to my channel, because I'm going to be following up on this story, and I'm also going to be following up on the most important fundamental catalyst that might happen, which is the possibility of an oil shock. The second thing, check out my link to my subscription service, because that's where you're going to be able to see exactly what it is that I'm trading in order to take advantage potentially of these scenarios. Now, nothing has happened yet, but I'm obviously sniffing something out. I'm sniffing out some possibilities, and there's going to be some big money-making possibilities. So if you're interested in what I'm doing in my portfolios, you'll be able to see the link to my service. So thanks very much for joining me, and I look forward to seeing you next time.